I'm Nicolas Bornozis of Capital Inc., and I am particularly privileged and proud to welcome you to today's event. This is the 20th annual Closed-End Funds and Global ETFs Forum. So we are celebrating today a major milestone. We have been able to keep this event going for 20 years, always with a great agenda, with great attendance, and this event has become one of the biggest events in the industry and an event that is widely anticipated year after year. As we were discussing just before coming on board among the panelists, please allow me to say there are not many organizations who can boast the claim of doing something for 20 years. So I'm particularly moved and proud to be able to do so with this event today. And just as a moment to reminisce, we started this event. Our first event was with Michael Porter, whom we honored 20 years ago. Michael helped us start this conference 20 years ago, and we honored him for his contribution to the closed-end fund industry. I would like to thank our advisory committee for helping one more year, Mariana Bush, Mike Jabara, and Alexander Reese. I would like to thank the New York Stock Exchange, and of course, I would like to thank all the sponsors who helped make this event possible. I'm particularly proud of the agenda we have this year. I mean, it's one of the best agendas we ever had, and we look forward to a great day of discussions and debate. And again, thank you to all very much, and a huge thanks to the Capital Inc. staff for keeping the flag up so high. Thank you to all of you. Mariana, the floor is yours.
Thank you very much, Nicolas. And as the moderator of the very first panel of this wonderful Capital Link conference, I and all the rest of the moderators and panelists and speakers of today's conference would like to thank you, Nicolas, and your incredible team for putting this together and for bringing us all together to share insights on closed-end funds and ETFs for the benefit of the audience. So thank you so much. This is a treat every year, and congratulations on the 20th anniversary. Our panel of very distinguished individuals in this industry, I will mention them briefly in alphabetical order of their firms. Bob Bush at Calamos, Jonathan Isaac at Eaton Vance, and Parth Doshi at Nuveen. So we're going to be covering three main topics that I think will interest you. And in some cases, we're going to use these as appetizers. May not go extremely deep into them because we don't want to steal the thunder of a few other panels that come after us. So if you think we didn't discuss something enough, there's a very good chance that we did that intentionally because there's more coming. So with that, let us start with the first topic, and that is valuations, meaning premium discounts of closed-end funds. I think a closed-end fund conference without a discussion on valuations and premium discounts would not be a closed-end fund conference. So let's start with that topic. Where they are rich. In general, we keep track of them for the entire universe of closed-end funds as well as some groups, and they are somewhat rich. We're going to discuss some of the reasons perhaps behind that. Bob, would you like to give us your insights on what you think is behind that and where we are in terms of premium discounts?
Sure, Mariana. You're quite right. The levels are rich on both a relative and an absolute basis. I think we've seen a little bit of a trade down over the last couple of weeks as you've seen volatility come into the market, across all levels. So you've seen a little bit of a narrowing of the premiums and maybe a little bit of smaller discounts come in, but still by and large, I think the pricing is rich. Why is that? I think there's a number of reasons for that. Obviously, you've had strong performance in the capital markets over the last a few years. Leverage, which is one of the best friends of the closed-end fund manager, Many of them borrow at short-term rates, and those have certainly been very accretive. And so what that's resulted in is many managers having the ability to increase their distribution levels. So I think, the closed-end funds held up very well as the general markets came out of COVID towards the end of last year. They responded well. A lot of those big discounts that we saw in March and April eroded as we saw the markets recover in the fourth quarter. And clearly we've seen the markets do well this year. So I think the desire for income is still there. I mean, we still have low interest rates, and a large portion of the buyers that buy closed-end funds are looking for income. So I think, the general markets, cheap leverage, good management, increase in distributions is really spawning what I think is a very, very healthy secondary market. And I think that's good for the space, and it's certainly good for IPO issuance, which we can talk about later on as well.
I think you're muted, Mariana.
Sorry, I do that all the time still. Parth and Jonathan, thank you, Jonathan. Any other comments that you would like to add to that?
No, I think Bob hit most of the high level facts. I took a look at the Closed-End Fund Association website this morning just to see they publish, I think it's LIPA numbers on these sort of averages, and I want to say that across all funds we were looking at something like a 2% discount, which I think we would talk about long-term averages being more like a 5% discount or in that kind of range. And maybe the most shocking thing was the fact that the average across bond closed-end funds was pretty close to par, which is certainly rich, as you note at the beginning. And I think we all know, or those of us who've been around this business a long time know, that interest rates are always a big factor in terms of where closed-end funds trade or tend to trade and where discounts tend to go. And I think the environment that we've been in over the last certainly 12 months has been beneficial to that. The spread between long and short term interest rates has remained intact, which Bob references is helpful as far as leverage product are concerned. The general thirst for yield across across the entire country, and particularly as far as retirees are concerned, we all again know that the closed-end funds are particularly attractive often to those investors. So I think a combination of all of these things, and as we say, that at least up until recently, the performance of just general asset classes have helped create this situation that we're in today.
Right. Well, the market or the universe for other vehicles like mutual funds and ETFs is much larger than that of closed-end funds. Boy, the investors of closed-end funds are incredibly loyal, and they love closed-end funds. So I think that I find that extremely interesting. Parth, any other additional comments from your side?
Yeah, I think I'd echo similar sentiments. Maybe the one comment I would add is kind of the valuations we're seeing may in fact actually reflect some of the value of closed-end funds, where we're seeing considerably higher distribution levels or rates compared to other wrappers. So that the benefits of low leverage costs and portfolios that have been invested up at considerably higher yields, 5, 10, 20 years ago, being able to then increase their distribution rates and pay out more than other fund formats, whether it's mutual funds or ETFs. I suppose in some ways, might not be surprising that we are seeing discounts so narrow or many funds trading at premiums. I think it's really a reflection of kind of this perfect storm of events for the closed-end fund market.
Thank you, Parth.
I think that's a great point. And if we were in person, it would be nice to poll the audience as to what asset classes they think look cheap today. So if we're still talking about average closed-end funds discount as a negative number, which it is, albeit 2% versus a longer term average, what else do they think looks cheap today if they look across the entire spectrum of assets, which again, I think must play into this current valuation trend.
Mm-hmm. And there is differentiation in valuation or levels of valuation depending on the asset class. Preferred covered calls are richer these days. Preferreds, for some reason, tend to be richer, have tended to be richer, and others like MLPs are much, much cheaper. Bob, while we were preparing for this panel, you brought up something that I thought was very interesting, and that is Zoom meetings. And I'm sure they will talk a little bit more about during the IPO panel a little bit later today. But I think you were saying that even if there is no IPO, Zoom meetings have allowed the sponsors, the closed-end fund sponsors, to reach out to many more financial advisors across the country in a much more efficient way. Can you tell us about that? I thought those comments were fascinating.
Sure. 2020 was an interesting event with respect to the closed-end fund space, and that, due to the COVID, the IPOs were unable to have many live meetings, if any at all. And so the deals that were done obviously had to be marketed vis-a-vis Zoom meetings, which turned out to be phenomenal and very popular. And we saw enormous raises done in 2020, and those big size deals continued into 2021. Obviously, we have the pricing structure is different, the no load, which is encouraged a lot of people to come in. But notwithstanding, we were able to concentrate in offices, which we normally would. But also there were other offices that perhaps vis-a-vis Zoom, you wouldn't be able to make physical visits to, that may have had, in smaller cities where they may have had good closed-end fund interest, but you just weren't able to physically get there because it's just the time and the schedule didn't go. Now with Zoom and the IPO process, they're able to hit multiple meetings in a day that weren't just necessarily focused on, meals, lunches, breakfasts, dinners, market close. Canvassed a whole bunch of different offices. I think that enabled you or the issuers to get in front of newer advisors, more advisors that may come into the closed-end fund space or look at the closed-end fund space without sort of preconceived notions in that they always go to discounts, they tend to underperform, they'll trade off when the markets trade off, they'll trade off when leverage prices go up, and so on and so forth. So I think it's opened this up. This whole Zoom concept has been wonderful, particularly in the closed-end fund space, because you're opening this up to more investors, more FAs, younger FAs that are just getting to understand and appreciate what the closed-end fund product offers their clients. And I think that's had phenomenal success. Again, not only in respect to the new issuance, but clearly with respect to support in the secondary market, which is critical in my mind for the IPO process to continue. You need a healthy secondary market to have a healthy IPO market. You want both of them. And I think that's really where we are right now. Notwithstanding the fact that you've had good performance in the capital markets, that's helped. So we're really in a good spot. And Zoom has just, I think, exacerbated all these good things that we're experiencing now in the closed-end fund market. And my expectation is, I'm interested to hear what the others think, is that this is a good thing that will continue.
I agree. I've said it many times. If closed-end funds had the same number of investors as mutual funds have, boy, I don't think there would be a discount in the closed-end fund industry. Sorry, Jonathan, you had something else?
No, I completely agree with what you just said, and was earlier just going to add one hopes that some of the reason for this is that new investors are becoming attracted to closed-end funds rather than people, as you say, who traditionally been attracted to them and are very loyal to them as a vehicle. But if I could just jump on Bob's comments around primary issuance, and be careful not to steal any of the thunder of the group that's coming, I think Dave Lamb at lunchtime, but I think there is a relevance there as it relates to the secondary market, where, as many of the audience may know, there's been a very healthy primary issuance over certainly the last 12 months, maybe a little longer than that. And typically in the past, if we look back, we've seen that those periods can maybe get a little out of control. I think if you look back 10 years, or maybe not 10 years, eight or 9 years, you would see certain months when sponsors would bring 4 or 5 funds to market during the same month. I think the underwriters of this latest phase of IPOs have been very careful to constrain the issuance, and generally speaking, only one new fund is being offered in any calendar month. And I really think that has helped the secondary market, because there isn't an overflow of new issuance coming in. There is some, and it's been healthy, and they've been good-sized funds. But I do think that's a phenomenon that is also helping the secondary market at the same time.
That makes perfect sense, Jonathan. And in fact, it seems like the closed-end funds may have been from the tortoise and the hare fable, may have been in the past many years ago, kind of the hare trying to raise as many assets as possible. But now we have settled into a much wiser tortoise pace, where it's slow but steady, and much better for the secondary market, much better for the primary market. I mean, we clearly see it on the primary market, which we're going to hear more later. So thank you for that comment. Let's move on to the second topic, mergers, so that we make sure that everybody who's listening here will be itching to listen to the I think it's the 12:30 panel on IPOs. But let's move on to mergers. That's one of a number of different corporate actions among closed-end funds. We see them as positive, generally, or for the most part, because they tend to create a bigger, much more liquid fund, especially if they're among 2 or 3 equals, and generally allow them to reduce expenses a bit. But Parth, do you want to tell us about that? I know Nuveen has, over the years, done a number of mergers.
Absolutely. So we at Nuveen have, I think, merged 96 funds with overlapping or similar strategies, and we think there's a lot of value for shareholders in this. We're able to deliver better expense economies, whether there's kind of fixed cost lowering based off of a bigger asset base, or for our particular fund complex, we have break-pointed fees, so we share the economies of scale with our investors as the funds grow through mergers. We also are able to see better kind of secondary market quality with more liquidity and larger funds, where investors that want to gain a particular exposure can kind of enter with size without disrupting or moving the market. So generally, we see a lot of benefits to shareholders for the mergers that we've done, and also that we're seeing in the industry as a whole. I think there's probably still some more mergers that will get done over the coming years, but I think there's been a lot of progress made over the last decade.
Thank you, Parth. Jonathan, anything?
Yeah, I think totally agree with everything that Parth said. I think it's beneficial for shareholders. I think generally speaking, it can be beneficial for fund sponsors. As many of the audience may be aware, a lot of the broker-dealer platforms have been doing what they call product rationalizations over the last few years. I think it generally began mainly in the open-end mutual fund space, where smaller and product without much in the way of assets or flows were kind of removed from platforms, just because there are so many open-end mutual funds. A similar project, I think, has emerged in the last couple of years, probably around closed-end funds also, where there are only so many that a due diligence team and an analyst such as yourself, Mariana, can kind of keep track of. And obviously, one way of sort of combating that, if you will, is to merge funds. So you end up with larger, hopefully more liquid products. You're not actually getting rid of them so the shareholder is still having the opportunity to invest. But as far as the broker-dealer is concerned, they got one fund rather than 3 or 4 maybe that they had in the past. So it definitely fits into a sort of an industry trend in that regard. The only downside, I would say, is the fact that a shareholder vote is obviously required in order to affect a fund merger. And while 5 or 10 years ago, a shareholder vote might have been seen as a fairly routine and an easy task to take, I would say today, both getting a shareholder vote, encouraging your shareholders to give you authority to do something like this is harder than it's ever been. And in addition to that, obviously opening your fund up to a shareholder vote potentially invites the opportunity for activist investors, if they exist in your fund, to do other things other than necessarily follow management's goal.
And Mariana,
Thank you for mentioning. Go ahead.
I'm sorry. It's sort of a natural progression if you think about it, these fund mergers, because back in the day, and I'm speaking from my investment banking experience, and Nuveen and Eaton and Vance were clients of mine, if there was a specific investment thesis that was popular, had merits, and the expectation was that particular thesis was going to be successful, you'd couple with the advisor and go out and raise a closed-end fund. And then down the road, several months, if that thesis still worked, but opportunities arose perhaps in a global format as opposed to the domestic that you'd just done, maybe doing a reprise, assuming the fund performed well and all the ideas were still in line, you'd go out and do maybe a global rendition of that. And so there were many funds that were done sort of as derivatives of the initial thesis that now 10 years later, it makes sense to consolidate them, given that the economy's bigger, the investments are broader, and so on, that they come back into, they sort of coalesce, if you will, sort of a natural progression.
Thank you, Bob, for that history. And thank you, Jonathan, for bringing this up, because I think the audience, it would be worthwhile for the audience to understand this, and hopefully they will be proactive and they will respond to those proxies. I have to say there was recently, a few months ago, a merger that we just assumed would go through because would be approved, because that has historically been the case. But we were surprised that it did not. And the first thing that came to mind was, what happened? Why did shareholders reject that merger? And it turns out it was as simple as they didn't get quorum. So it is a challenge. It does become expensive for the funds. So any suggestions for the audience, for financial advisors as to what to do? I mean, just answer basically to make sure that it does not become expensive, because that's at the detriment of shareholders to not get it through, not get it approved, or not get enough votes, and then have to do it again. And any words of wisdom, suggestions?
Vote your shares. But no, in all seriousness, I think I agree. Especially in this environment where everyone's working from home, and people are working maybe not from their home, moving somewhere longer term, and people aren't going into their offices, have that same routine. I think it's become increasingly difficult to reach shareholders and have them vote and attain quorum. So unfortunately, no advice, but definitely agree with the challenge.
Yeah, I think that's right, and as I'm sure many in the audience know, we typically don't have a whole lot of reach out to our underlying shareholder base. Much of, or many of closed-end funds tend to be sold on the advice of financial advisors. So any support we can get from them when it comes to things like shareholder votes, assuming they agree with what's being proposed. I mean, obviously they need to understand exactly what is going on, but assuming that, I think the actual process has become pretty easy in terms of, you can do it online or whatever. This is not a complicated process. And I also am fully aware of how irritating the amount of mail or phone calls or reminders that could be sent when someone doesn't vote. But again, as a sponsor, all you can try and do is reach these people and encourage them to use their right to vote.
Thank you. I'm getting a question here that is related to mergers. So instead of waiting until the end, I'm going to mention that one here. And it is about any around dividend changes for funds after the merger, and also on, is there a risk of there being too much concentration in the larger surviving merged fund? Any comments on that?
I can say from
Jonathan, you're mute. Or Parth, go ahead. Go ahead.
I can say from a Nuveen standpoint, I mean, we're certainly mindful of merging when we've done mergers, we don't want to force a distribution reduction as a result of the merger. So we're certainly looking at the earnings profiles of funds when if and when a merger is proposed. So I would say from our standpoint, I wouldn't necessarily think of a dividend reduction as directly tied to a merger, but hard for me to maybe speak for the industry as a whole, because there's a lot of facts and circumstances in these merger proposals that can be quite complex and impact the distribution that's paid.
Yeah, I think that's right. And obviously, the board of trustees for the funds are there to make sure that whatever is being proposed is in the best interests of the shareholders of kind of all of the merged entities. And I would say that being able to deliver a distribution at least comparable to what those shareholders are experiencing today would be one of the #1 kind of items in that examination. In terms of the size of the merged funds, I think that's a little bit dependent on what asset class you're talking about doing it. So I think it's tough to make a generalization, but I think most of us would agree that a big generalization here, but bigger is better in closed-end funds, and particularly when it comes to things like liquidity of the underlying shares of the fund.
Right, and generally, as long as the starting funds are diversified, there is really not necessarily a reason for the surviving fund to be more concentrated. So I'm not sure there is that risk there. What often happens is that the funds that are merging end up being very similar portfolios. So as the combined portfolio is again very similar to where they came from. I just wanted to point out one technicality that funds need to do right before they merge, and I wonder if the person asking the question, maybe they were referring to this, is if there is an undistributed net investment income in the fund, they need to distribute that before the actual merger. So sometimes you'll see right prior to a merger, there is a special distribution, and that's what it is. Anything else on mergers? Okay, well, let's move on to our third topic, and this is actually a somewhat new topic for closed-end funds, maybe not for ETFs, but for closed-end funds. And thank you, Jonathan, for kind of suggesting this. I think it is timely, and that is a ESG or sustainable investing topic, which is popular in the media and certainly among ETFs as well, but it hasn't really been a common topic among closed-end funds. And while there is not substantial selection by ESG for existing funds, it is among some of the newer funds. They have this theme. So Bob, would you like to talk about this?
Yeah, I mean, the thing about closed-end funds is that they do evolve, and we've seen this with respect to issuance. We've seen this over the many years that we've all been doing this. You know, it's not necessarily what is you know, it's a lot of times it's what folks are looking for, what investors are looking for, what new ideas are out there, and certainly that's reflected, I think, in the content of the closed-end funds. And so, you know, you're seeing ESG. In fact, Blackrock just raised over a $2 billion deal last month with a fund that was 80% of the investments would be in either debt or equity instruments in securities that they deem for the criteria of ESG. So obviously there's a lot of interest that, you know, so you've seen things like that. You've seen privates. Many of the portfolios that are getting done are with respect to private investments. You're also seeing, and I know as a research analyst, you'll appreciate this, Mariana, you're seeing a lot more funds that are being done with sort of an open architecture or another open allocation. In other words, kind of a go anywhere fund. You're seeing more of those. I remember during the day when I was in banking days, that was sort of, you wanted to do it, but you needed to have sort of more parameters around the product before you went out. That seems to be changed a little bit, and that there seems to be, I guess, more research, perhaps more sales management, ability to kind of trust the manager that they're going to do the right thing, whether it be based on open-end history, existing closed-end fund history, portfolio manager history. So I think the parameters certainly change. And that's, again, the beauty of the closed-end fund space is that you have the best managers in the land that get these done, because the criteria to get them done are very difficult and very onerous. They typically have broad sales forces that they can communicate these new ideas out through. So again, I think that's what the closed-end fund offers, is retail investors, or any investor for that matter, access to opportunities that they may not be able to get in the context of other vehicles. And I guess, you know, that's just the way this space has been working, and it's a credit to the issuers, and I think to the sales management areas to be able to stay with it.
Thank you, Bob. You mentioned a BlackRock fund, and I know that Stephen Menard from BlackRock will be on the IPO panel shortly. But Parth, I know that Nuveen also has been in this space. Tell us about that.
Yeah, of course. So we launched a fund earlier this year that's really focused on impact investing, where we're seeking to provide exposure to issuers or individual projects that have social or environmental benefits, and most importantly, deliver competitive financial returns. So I thought kind of Bob described it well. This is, I think, a natural evolution in the market. I don't think you can pick up a financial newspaper today without, seeing at least one article or one discussion of ESG. This is, something that is becoming a greater focus of all of our investment teams at Nuveen, and we're seeing greater demand from advisors and their clients as well. So our fund that we launched earlier this year was really focused on fixed income impact investing, and identifying projects that could deliver a environmental or social benefit along with competitive returns.
Thank you. Jonathan, anything that you'd like to add?
I guess maybe just some general comments, and I agree with what both Bob and Parth have talked about. We have not issued any ESG product as yet. We've certainly thought about it. And really our sort of greater involvement with ESG dates back 3 or 4 years to when we purchased the assets of Calvert Research and Management, who were one of the oldest ESG managers out there. And I think the comment I would just make as it relates to the industry as a whole is I really feel like in that 4-year period, we've seen the change from lots of talk, lots of written stuff about ESG, as the others have mentioned, to some real assets going to ESG investments. And I definitely feel that change has happened. And I think it's important that the closed-end fund industry kind of recognizes that also, because I think it would be a great evolution for us to take. The other comment that I would just make is just, and again, this is more for financial advisors in the audience, is just how important I think this can be for their business in terms of attracting new clients. As I think we all know, women tend to be more attracted to responsible investing. Millennials, I think we all know, tend to be more attracted to responsible investing. That, to me, is a great opportunity for financial advisors to kind of educate themselves and become better at speaking about this, and obviously the greater breadth of product that's then available to them to help their clients, including hopefully closed-end funds, can come into play.
I mean, Mariana, as you well know, oftentimes what goes on in the mutual fund world precedes what goes on in the closed-end fund world as far as products, innovations, ideas. Not all the time, but many times it does. So ESG has gained popularity. Obviously, there are teams that are established in the asset management worlds, and assets are raised through the mutual funds. And while sales is out there talking about this in the mutual fund context, you know, the idea is, well, geez, what could we do in the closed-end fund side? You know, perhaps there could be a nuance to it that would be different than the mutual fund. Perhaps we put some leverage on it. Perhaps we could go throw perhaps some privates in there, and so on and so forth. So typically it starts in the mutual fund arena, and then it's embellished in the context of the closed-end fund. So basically what you're doing is you're satisfying the needs and demands of your clients in both a mutual fund open-end structure and the benefits of the closed-end fund structure.
Right. Mutual funds or ETFs, I guess.
Or an ETF.
There's so much money going to ETFs these days.
Oh, absolutely, absolutely, absolutely. Mm-hmm.
Great. We have just a few more minutes to go, and there is a question that is asking about prognosis and risk for fixed income versus equities. And all of your firms have a little bit of both, and sometimes both in one fund. Do you want to share some thoughts on that?
Well, I'll take a stab. I think the concern in the closed-end fund space is that if you have rising interest rates, or in general, if you have rising interest rates, that's going to have a negative impact on bond pricing. And of course, rising interest rates, there's always a concern about the cost of leverage, which that they think it could be that could impair the ability of a closed-end fund to maintain its distribution, perhaps could result in distribution cuts. So I think, you know, you have to think in terms of what assets may do better in a rising interest rate environment, what interest rates may do better with leverage versus non-leverage. I mean, there's a lot of things out there. What investments may do better in a higher volatility environment that we may be getting ourselves into. So again, I think you have to look at what your investors' profile is, what your thoughts are on the general market, and there are plenty of closed-end funds out there that can accommodate whatever your general thinking is.
Yeah, I think it's very difficult to make a general statement. If I just off the top of my head think about what we manage in the closed-end fund space, you've got leveraged equity. That's pretty risky. You've got covered call, which is probably a much less risky way of investing in equities. You've got long-term municipal bonds, which, to Bob's point about rates, long-term rates start going up, that's an issue. But at the same time, you've got bank loans, which potentially would benefit from something like that. So it really does require analysis of the underlying funds rather than to say that one area or another looks particularly risky. I think we all agree that valuations are pretty rich right now, no question about that. But again, to go back to where we started, that's true across everything. So tough to pick out one area that we feel is riskier than another.
And in less than 1 minute, Parth, because that's kind of all that we have. Any other comments?
Just one thought I might pose is to consider what are you investing for over the long term. I think closed-end fund investors are generally looking for income, and so look at what strategy can kind of deliver that particular outcome in a kind of durable and resilient manner over the long term. And there's probably equity and fixed income strategies that could meet that need. And I might, reframe the question about what is the outcome you're investing towards.
Thank you. Well, with that, Nicolas is showing up, so that's a cue for our panel is over. Thank you so much, Bob, Jonathan, and Parth, for a wonderful panel early in the morning. Thank you.
Thank you.
Well, I'd like to thank you as well, closing this panel. And also, if you allow me, I would like to express a personal note of thanks to the four of you. One of the great things that we have developed over this 20-year period is I think we have developed a group of faithful partners who support this event year after year. So I really thank you very much for your support, for your brainpower contribution to the event, and for your financial support. So thank you to all of you very much.
Thank you.
Thank you, Nicolas.